The phantom is real. The phantom tax is not a conspiracy. It's not a glitch. It's the natural result of a system that rewards deferral and then punishes distribution. You think you're done paying taxes. You worked 40 years. You maxed out the 401k. You deferred, because every single financial guru with a podcast told you to do the same thing. Pay the tax later. You'll be in a lower bracket in retirement. Maybe you bought that. Maybe you even felt smart. But here's the problem. Retirement doesn't lower your tax bill. It hides it. It hides it in three things that sound boring on purpose: RMDs, Social Security taxation, and something called IRMAA. They sound like government sleep aids. That's by design. But together they can turn your normal retirement income into a tax rate that would make your working self choke. I'm John Conrad, forensic accountant and founder of Numeratus.us, with a white glove concierge accounting firm for ambitious startups, entrepreneurs, and high net worth clients. We cut through the complexity, eliminate compliance roadblocks, and help you safely navigate business and wealth protection in the 21st century. In this video, I'm going to walk you through one real couple's tax return, year by year, and show you exactly where their money leaks out. Then I'm going to give you a simple 3-bucket withdrawal strategy you can use immediately. No jargon, no financial planning gatekeeping, just the truth, with a few analogies that will make you furious you didn't hear this sooner. Let me start with a story you've probably heard. If you drop a frog into boiling water, it jumps out immediately. But if you put it in lukewarm water, slowly turn up the heat, it sits there until it cooks. That's retirement taxes. While you're working, taxes are loud. You see them on every paycheck. You feel them. In retirement, they're quiet. They don't show up as one big bill. They show up as a forced withdrawal you didn't ask for, a Social Security check that's smaller than you expected, a Medicare premium that suddenly jumps by $2,000 a year. Stacked together, they're a wealth destruction machine. And the people running it are not your enemy. They're just the IRS, Social Security, and Medicare, 3 departments that do not coordinate with each other, but all happen to use the same number on your tax return. That number is called MAGI. Modified Adjusted Gross Income. And if you don't control it, it controls you. Let's make this real. Meet Jim and Linda. They're both 67. They live in Ohio. They have $1.2 million in traditional 401ks and IRAs, $200,000 in a regular brokerage account, $100,000 in a Roth IRA, combined Social Security of $48,000 a year. They think they're middle-class retirees. They think their tax life is simple. Their goal is simple: pull about $80,000 a year from their portfolio, plus Social Security, and live a very comfortable life. That's $128,000 a year in cash flow. Not extravagant, just normal. But normal is where the phantom lives. The phantom tax, that is. In year 1, Jim and Linda are 67. They're not required to take RMDs yet. That starts at 73 now, thanks to the recent rule updates. So they decide to pull $40,000 from Jim's traditional IRA, $40,000 from Linda's. They also take the $48,000 at Social Security. Here's what they think their picture will look like: $80,000 from retirement accounts, some of it tax-free Social Security, standard deduction, maybe we pay a little tax. Here's what actually happens. First, the $80,000 from the traditional IRAs is fully taxable as ordinary income. Second, Social Security is taxed based on something called combined income. Combined income is your adjusted gross income plus tax-exempt interest plus half your Social Security benefits. So Jim and Linda, $80,000 in IRA withdrawals plus $24,000, which is half of their Social Security, equals $104,000 in combined income. If your combined income is over $34,000 as a couple, up to 85% of your Social Security becomes taxable. Instead of $48,000 of tax-free Social Security, $40,800 of it is taxable. Jim and Linda's taxable income is now $80,000 from IRAs, plus the $40,800 from Social Security, minus the standard deduction of about $32,000, equals roughly $88,800 in taxable income. Their federal tax bill, around $10,500. That's an effective federal tax rate of about 8.2% on their $128,000 cash flow. Not terrible, but also not nothing. They could have paid almost nothing if they pulled it differently. But they didn't know. When they paid $10,500, they didn't need to pay. Now Jim and Linda turned 73. RMDs kick in. Remember RMDs? An RMD is a required minimum distribution. And it's the government saying, hey, we let you defer your taxes for decades. Time's up. Start taking money out now, whether you need it or not. The RMD amount is based on your age and your account balance. At 73, the divisor is about 26.5. So if Jim and Linda's $1.2 million IRA grows to $1.3 million by 73, their first RMD is roughly $49,000. They already wanted $80,000 from their portfolio. Now the IRS forces them to take $49,000 from the traditional IRA before they can touch anything else. So their taxable IRA income jumps from $80,000 to $98,000, even though their spending didn't change at all. Now let's recalculate the combined income. $98,000 from IRAs plus $24,000, which is half of the Social Security, equals $122,000. That pushes even more of their Social Security into taxable territory. Now 85% is taxable. That's the max. Taxable income, $98,000 from the IRAs plus $40,800 from Social Security minus the standard deduction equals roughly $106,800. Federal tax bill, around $14,500. Their effective rate on $146,000 worth of cash, about 9.9%. It's still not catastrophic, but it's getting worse. It didn't do anything. The water just got warmer. Now we introduce the third phantom, IRMAA. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a surcharge on your Medicare Part B and Part D premiums based on your income 2 years prior. In plain English, if your income is too high, Medicare charges you more. For 2024, the standard Medicare Part B premium is about $175 a month per person. But if your MAGI, modified adjusted gross income, crosses $206,000 as a couple, the premium starts climbing. At $246,000, you're paying roughly $244 per person per month. At $306,000, you're paying about $350 per person per month. At $366,000, you're paying about $455 per person per month. And at $750,000 and above, you're paying about $560 per month. That's per person, per month, for the same Medicare. Jim and Linda are nowhere near the top bracket, but they don't need to be. Because of the RMD and the taxable Social Security, their MAGI, modified adjusted gross income, is now around $138,800. They're below the first IRMAA threshold, so in this year they dodge it. But here's the trap. IRMAA looks at your income from 2 years ago, so the decisions Jim and Linda made at 71 are now raising their Medicare premiums at 73. And if they keep pulling from the traditional IRA the way they are, by age 75 their account could be large enough that the RMD alone pushes them over the IRMAA line. 1 year of bad withdrawals can create a 2-year Medicare penalty. That's not a tax, but it functions exactly like one. Let's add it up. By age 75, Jim and Linda might be looking at $18,000 in federal income tax, $3,000 to $6,000 in extra Medicare premiums for IRMAA, maybe another $1,000 or more in state tax depending on where they live. That's $25,000 leaving their household every year on what they think of as normal retirement income. Their effective tax and surcharge rate is now pushing them 15% or higher. This is a couple with $1.5 million in assets. They are not rich by financial media standards. They're the people who did everything right. They saved, they deferred, they followed the rules. And the system is eating 15 cents on every one of their dollars. That's the phantom tax. It's not one line item. It's 3 systems quietly agreeing to take more from the same pot of money. So why didn't anyone warn Jim and Linda about this? 3 reasons. First, the people giving retirement advice today often make money from assets under their management. They get paid on the balance, not on how tax efficiently you withdraw it. Second, the tax code is designed to be boring. RMD, MAGI, IRMAA, these are all words that make normal people's eyes glaze over so they don't ask questions. Third, and this is the big one, the pain is delayed. When you're 45 and contributing to a 401k, you feel smart. You feel like you're doing it right. You see the balance growing. You get a tax deduction. It's immediate gratification. The bill doesn't come due until you're 73, and the IRS starts forcing withdrawals. By then, it's too late to restructure. Let's fix it. The solution is not some complex trust in the Cayman Islands. It's not a reverse mortgage. It's not day trading your way out of this. The solution is pull from the right bucket at the right time. Think of your retirement money like 3 buckets. Bucket 1, tax deferred. This is your traditional 401ks, traditional IRAs, SEP IRAs, 403bs, whatever. Every dollar that comes out is taxable as ordinary income, period. This is the bucket the government wants you to drain because that's how they get paid. Bucket 2, taxable. This is your regular brokerage account. You already pay tax on the money you put in. When you sell investments, you pay capital gains tax, but only on growth. And long-term capital gains rates are usually 0, 15, or 20%, much better than ordinary income rates. You control when you realize the gains. You can harvest losses. You can choose which shares to sell. Bucket 3 is tax-free. This is your Roth IRA, Roth 401k. health savings account, and maybe municipal bonds. It does not count towards your magi. It does not trigger IRMAA. It does not make Social Security taxable. This is your stealth bucket. The goal of a smart withdrawal strategy is simple. Use the taxable and tax-free buckets to control your MAGI, so you drain the tax-deferred buckets on your terms, not the IRS's. Let's rewind Jim and Linda to age 67. They want $80,000 from their portfolio, plus $48,000 in Social Security. Instead of pulling $80,000 from their traditional IRA, here's a better plan. Step 1, they only take what they need from a traditional IRA to stay within the 12% tax bracket. After the standard deduction, that means they can save roughly $126,000 in gross income before they hit the 22% bracket. But they don't want to use all of that space on IRA withdrawals because they want to leave room for Social Security taxation. Step 2, they'll fill the rest of their spending needs from the taxable brokerage account. Let's say they pull $30,000 from their traditional IRAs and $50,000 from their brokerage account. The brokerage sale might only create $20,000 in capital gains, depending on their cost basis. Now their MAGI is roughly $30,000 of IRA withdrawals, plus $20,000 in capital gains, plus $24,000, which is half of their Social Security, equals $74,000 in combined income. That keeps them below the threshold where 85% of their Social Security gets taxed. In fact, at that level, only 50% of their Social Security is taxable. So their taxable income is $30,000 from the IRA, plus $20,000 of capital gains, plus $24,000 from Social Security, minus the standard deduction, that equals roughly $42,000. The federal tax they paid? Around $2,500. They just saved $8,000 a year in federal tax without changing their lifestyle at all. Now here's where we can go further. Between retirement age 73, there's a window, very sweet spot. You're no longer earning a paycheck. You're not yet forced to take out RMDs. Your income is artificially low. This is the perfect time to do a Roth conversion. A Roth conversion means moving money from your traditional IRA into a Roth IRA. You pay tax now, but once it's in the Roth, it grows tax-free forever, and withdrawals are tax-free. And you may ask, why would you voluntarily pay tax early? Because you can control the rate. If Jim and Linda convert $40,000 a year from age 67 to 72, they pay a tax rate at 12% or 15% on that money. Then at 73, their traditional IRA is smaller, their RMD is smaller, their MAGI is lower, their Social Security is less taxed, their Medicare premiums stay lower. They front load a small tax bill to avoid a much bigger one later. It's like fixing a leaky roof before the storm. Here's the simple version you can write down. Before age 73, live off taxable accounts first. Use Roth conversions to fill up low tax brackets. Delay traditional IRA withdrawals as long as possible. After age 73, take your RMDs. You really have no choice. Fill remaining spending needs from taxable accounts. Use Roth money last. It's your tax-free reserve. This is the opposite of what most people do because they're on autopilot mode. Most people drain the traditional IRA first because that's where the biggest balance is. It feels natural, but it's also the most expensive way. The government wants you to do it that way. Don't do it. Retirement planning is not about how much money you have. It's about how much money you keep. $1 million in a traditional IRA is not the same as $1 million in a Roth IRA. It's not the same as $1 million in a brokerage account. They look the same on your net worth statement. They spend very differently. Think of it like 3 identical looking cars. One runs on gasoline and needs a special license. One is electric and charges for free. One is a hybrid that you can fuel however you want. They all look like cars. They do not cost the same to drive. Your job in retirement is not to pick the car with the biggest engine. It's to pick the one with the right fuel at the right station. If you're watching this and you're between 60 and 72, you have the most power. Here's your action list. 1, figure out your current MAGI. Look at last year's tax return. Add your adjusted gross income, tax-exempt interest, and half of your Social Security. That's your combined income. That's what controls your Social Security taxation. 2, project your RMDs. Take your traditional IRA balance, divide it by the RMD factor for your age. You can find the IRS Uniform Lifetime Table online. Yes, it's an actuary table. That number is coming whether you like it or not. 3, model a better withdrawal plan. Use a spreadsheet. Hire a flat fee planner for one session, or use tax software to compare scenarios. The goal is not how much can I spend. The question is which bucket should I spend from first. 4, consider Roth conversions before 73. Even small conversions matter. $20,000 a year for 5 years is $100,000 moved out of the tax-deferred bucket. That's $100,000 that will never be subject to RMDs, IRMAA, or Social Security taxation. Let's close with this. The phantom is real. The phantom tax is not a conspiracy. It's not a glitch. It's the natural result of a system that rewards deferral and then punishes distribution. You were told to save in a 401k because it saved you money today. Nobody told you that the bill would come due when you have less flexibility to pay for it. RMDs force income. Social Security taxation amplifies it. IRMAA punishes it. These separate systems, one shared number, one quiet wealth drain. But now you see it, and it's not spooky. And once you see it, you can stop it. Use the 3-bucket strategy. Control your magi, convert before 73, and stop letting the government decide which of the dollars you get to keep. If this made you angry in a useful way, that's the point. The whole month of June, I've released a series of videos on retirement accounts. Please watch them, drop a comment, subscribe, because the people who figure this out early are the ones who retire with more. Not because they earned more, because they kept more. See you in the next one.